A covered call is a financial strategy that can help investors generate income and protect against market volatility. Here's how it works. Imagine you own a stock that you think will not rise much in the near future. You can sell a call option on that stock to someone else. A call option is a contract that gives the buyer the right to buy the stock from you at a specific price, called the strike price, before a certain date. By selling the call option, you receive a premium, which is like a fee for selling the option. If the stock price stays below the strike price, the buyer of the call option will not exercise their right to buy the stock from you. In this case, you keep the premium and the stock. If the stock price rises above the strike price, the buyer of the call option will exercise their right to buy the stock from you at the lower strike price. In this case, you still keep the premium, but you must sell the stock to the buyer at the lower strike price. Here's an example. Let's say you own 100 shares of XYZ stock, which is currently trading at $50 per share. You sell a call option on your shares with a strike price of $55 and an expiration date of 1 month from now. You receive a premium of $1 per share, or $100 total. If the stock price stays below $55, the buyer of the call option will not exercise their right to buy the stock from you. You keep the $100 premium and the 100 shares of XYZ stock. If the stock price rises above $55, the buyer of the call option will exercise their right to buy the stock from you at the lower strike price of $55. You still keep the $100 premium, but you must sell the 100 shares of XYZ stock to the buyer at $55 per share. This means you receive $5,500 for the sale of the stock, plus the $100 premium, for a total of $5,600. The main advantage of covered calls is that they provide protection against market volatility. If the stock price drops during the call's life, you can still generate a profit through the covered call, even if the underlying stock price doesn't drop enough to cover the option cost. Additionally, covered calls can create a compounding effect, as you can sell additional calls to cover the original call, generating additional profits over time. In summary, covered calls are a great way to generate income and protect against market volatility. By selling a call option on a stock you own, you can receive a premium and potentially profit from the stock's price staying below the strike price. The protection against market volatility and the potential for compounding profits make covered calls an attractive option for many investors.